Welcome to my new video. Happy New Year to you. Let's hope 2021 is a bit better than 2020. Having said that, though, I did a Twitter survey. I'll be covering that in this video. People's investment returns who took part in the survey, and it's very good, I thought. And in fact, this year for me on the markets hasn't been that bad. There was that sell-off in March. It scared the living pants out of lots of people, but exciting, you know. But yeah, I'll be looking at that. I'll be looking at my returns over the last 10 years. I'll be looking at a stock that I feel quite confident about in 2021. And by all means, if you want the next video to your inbox and you haven't subscribed, hit that subscribe button and the notification bell and you get the next one straight to your inbox. Okay, let's get into it. Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. This is a survey I did on Twitter, the investor returns of people who took part in the survey. And this is excellent. So 760 votes. This was, what did your portfolio do in 2020? 8.2% were down 30% or more. I suggest that's maybe holding too few stocks. You know, you've got to hold a decent amount of diversity. 10% were like between 0 and 30% down. But this is excellent. Look at this. Nearly a third of people were up, nearly close to between 0 and 30. And 50 point, so over half were up over 30%. That's phenomenal returns. I say, well done. Because if you compare this, and it's all about, you know, return of your money. Where's the best return you can get? Gilts and bonds, less than half of 1%. You know, banks, less than 2%. And global stock indices, they achieved 7.6%. So you're outperforming the market, you know, which is very good. That's what fund managers attempt to do, that outperform the market, basically the benchmark, you know. And so if you're in those, you know, in that category that did do that, over 8%, you've done that. And let's be honest, it's more fun doing it yourself than giving it to somebody else. But I think the stock market will continue to do well. Why? Tina. There is no alternative. You know, if you want a decent return on your pound, where do you get, you know, where else do you put your money? You can't put it in banks that give less than 2%. Pointless. And so if you're watching this and you're a new investor, think about that. Even a fund, you know, a well-diversified fund will get you a lot better return than just keeping your money in a bank. It's wasting away. In fact, inflation's a little bit low, but I think at the moment, what is it? Inflation is around about, I don't think you're earning any money if it's eroding your money, keeping it in a bank. So you've got to, you know, make your money work for you. That's why investing is so important and learning about it. Okay, my returns dating back to 2009, I've data from. And in fact, somebody said this to me. Your transparency gives you great credibility. Just started watching some of your YouTube videos as a newbie. Such simple, invaluable advice. Have a prosperous 2020. I think you mean 2021, but that's pretty tell, so it's nice. And there's two reasons why I do this, and I think you should do it as well, okay? I show my returns for two reasons. You can't manage what you can't measure, all right? How can I avoid my mistakes or build on my strengths if I don't record what they are? Okay, and if you are in that category, let's go back, where you are down here somewhere, okay? Well, anywhere, really, but I mean, you know, if you've lost money, it's a mistake if you don't learn from it. You know, it's a lesson if you learn from it. And that's good. So if you keep learning all the time, you get better. Simple as that. We've all had down years. We've all had big losses, you know. But if you learn from them, you get better. So that's one of the reasons why I do it, is because I try and write down. That's why I've got a filter of rules. I go through a quality filter, which I attempt to, you know, reduce the risk on any investment I make, but keep the reward. And secondly, I talk about stocks that I think have potential. Why should people pay any attention to me? You know, what are my credentials? It can only be based on my track record. You know, I would never go to you know, a builder and say, "Come and build something," without having no knowledge about what he's done before, if he's any good whatsoever. And so, if someone is you know, on Twitter and promoting stocks, it's worth asking what's their returns. You know, and I think people should, you know, publish their returns, because if they think they're convinced a stock will go to the moon, what are they basing this on? What experience? What track record are they basing this on? You know, are they good at investing? Have they got a proven track record? It's just transparency. I think everyone should do this. Everyone should try and it's good for you anyway. Like I said in the first bit, if you don't measure it, you can't improve it. So I think everyone should try and keep a record of their, you know, of their returns, and also adjust their mistakes, and, you know, winners and losers, because you learn from both ends of that spectrum there. Okay, over the last month, December wasn't a good month for me. 1.6 1.64% down. It was good over the last 3 months. I did 37.2% in the last quarter, which is decent. In the last year, I did, this is taken from screenshots from my Barclays ISA account, 86% I did. I mean, that's up there. I've done more than that percentage-wise, but as the portfolio grows, it becomes harder to do that. It's probably the most money I've earned in a year in ISA, and that's just because I'm always learning. I'm hopefully getting better and better at it. I'm always learning. No one knows everything about stock market investing. There's always experts out there, and the predictions they make very rarely come true. Over the last 3 years, I've done that 446%. And this is a start of, since I started investing pretty much, I had data. I started investing in dot-com bubble pop in 2000s, basically. I did really badly then. I lost more money than I had. But since 2009, 17th of November, I've done 5,100%. How much is that? It's 61 times my original portfolio value, okay, since December. So if I started off with £1,000, I would have had £61,000 now in the last 11 years. If I start off with 10 grand, 610,000. If I start off with 100 grand, I'd have 6.1 million. So it just shows you how much I've scaled up in the last thing. And that can be anyone. I'm not doing that boasting. You can do that. You know, back in 2009, I knew a lot less about investing than I did now, but I still sort of managed to get by. And you can do it. And I'd say writing things down, you know, where you went wrong on an investment or a trade, you know, where you went right on an investment, write them down. You know, it's good to have rules, but sticking by them is even harder, you know. So write them down. It's always worth doing, okay? This is my holdings right now, by the way. This is from Barclays Escape Hunt there, 79% up, on the market at 31%. Illica up 105%, Valerian 109%, Gefinity 93%, and Trackwise 35.1%. A lot of these I've scaled up into, and it's gone up basically. So that's why the actual gain, if I just put my initial amount in, let it ride, a bit more than that. But I've bought more on the way up. So that's why they average down. Okay, these are the ones I've talked and covered about in Twitter, blog posts, or video over the last 2 years. 25 stocks, pretty much. Okay, the biggest winner, which I jumped out way too early on. I don't know if I made money on it. That was a mistake. I'm going to learn from a lack of patience. The theme was right. Clean energy, going from basically taking waste that nobody wants and converting it into clean energy. That's alchemy. That's changing base metals into gold, pretty much. And I kept saying that, but I lost patience and I jumped out. And Powers Energy has now done 2,200% since when I first covered them, right there. Argo Blockchain again. I was convinced that I did several videos on Bitcoin and Argo Blockchain. I didn't heed my own advice, and it's now up 355%, 4 times your money, 4.5 times your money there. Up Northern as well, I got that too early. And where education go? I got these 3. I jumped out way too early. I'm not going to make that mistake again. But right now, these are the ones I own in yellow. So Player, when I first started talking about it, like I said, I averaged up previously. That's why it's only 109% here. But obviously, you get more monetary gain. Gefinity, Escape Hunt. Illica on the market, Trackwise. Okay, I mentioned Illica. In fact, I mentioned Illica on Twitter at 121. I actually got in there at about £1. I averaged about £1. So 25 grand would turn into 64 grand. So what is that return of in the last couple of years? If you'd invest in those stocks £1,000 each, you'd get a return of 64,000. That's a return of 159% over 2 years, which is a decent return, And to think I give up on most of those stocks, that's cost me a lot of money. I was silly doing that. So there are some bad ones down here, like Xeros, a bad fundraiser did, which is 80% down. Fundraise, Safe Stay. Of course, listen, these kind of stocks will rebound. Safe Stay, Big Dish, that's not going to happen. But Emotion and Safe Stay, they're in the leisure industries. That'll bounce back. They'll bounce back in a British guarantee this year. So my first pick for 2021. Some of you will think this is no surprise. It's my biggest holding, and the reason I'm not promoting it because it's my biggest holding. It's my biggest holding because I think it's going to perform very well. And it's Escape Hunt, right? 12.26 million, down on Friday, went down about 9%. I was a seller in there, drip feeding. So when there's a seller in there, there's always opportunity, because sellers can get out for no, especially if it's a fund or investment, they can get out for no reason sometimes. It's pull certain investments, nothing to do with the company. So it was down Friday, 12.2 million. I think this is so undervalued. And I've given 5 reasons why I think this will do very well in 2021. The sector, right? Travel, leisure and hospitality and banks, by the way, were the biggest fallers during the coronavirus lockdowns. I think banks will take longer to rebound because the economy is going to take a while to repair anyway. But they will be the biggest risers during the recovery. And this recovery was going to happen this year. First quarter, we're going to maybe have a bit of a dodgy. In fact, I think we'll start rallying before the end of the first quarter because the stock market looks ahead. So the anticipation of the recovery, vaccinations will be going up to 1 million, 2 million a week. And when we do that by spring, most people will be vaccinated and need to be. So I think the lockdowns will end and people will start going back. And people are dying to go back out. My wife is going mad trying to book holidays for this year, 2021. I mean, because and part of me would have said slow down, but because we didn't have so many holidays last year, and at the moment she's getting them quite cheap. I don't think they'll be cheap. I think holiday prices will rocket very soon because people will want to go on holidays again, get out there, go to restaurants, socialise, do those things they couldn't do in 2020. That's why I think the recovery will be massive. So these hammered down stocks will rally. Escape Hunt is in this category, okay? Return to growth is the second reason, okay? Look at the full year results, the 31st of December. This is before coronavirus was around. Group revenue up 128%. Revenue from owner-operated sites up 275%. Right? And even in the 9 weeks to March, it's a bit bigger now than more. The revenues from owner-operated sites were up 65% compared to the same period last year and 55% on a like-for-like basis. So that's, like-for-like, up 55%. That is excellent growth. There is demand here for their product. It's a premium product. I mean, they've got excellent sites, locations, plus the hookups for a bit like the BBC, Netflix. Those people don't hook up with tin pot companies, Return to bigger growth. This is my second reason. Was my third reason. So return to growth, second. Return to bigger growth. Why? Before lockdown, they had 11 sites. Now they've got 15 sites. Okay? Do the math on that. What's that? Nearly 40% bigger? Is it? Something like that. Someone let me know. End of 2021, they left out 20 sites. They've doubled what they had before lockdown almost, So these are where the sites are at the moment. They'll have more than that, a lot more than that by 2020. And like I said, demand is there. The growth is there. So it'll come back. It'll return. People are dying to go back out and do normal things again. It's just reversion to mean. Reason 4, return to bigger growth on better terms. So look at this, 14th of December, okay, they announced this, and the formal opening of this newest site in Watford is now scheduled for the 27th of December. Obviously that wasn't happening because of lockdown, but the site of Watford represents a milestone, as the game rooms have been constructed using our next generation designs, which are fully modular. What does that mean? Basically, it enables the rooms to be moved and reinstalled within the company's estate. So they've got lots of different games. Certain sites have 4 games, others have 6 games. Then you've got sort of VR games and outdoor games as well. But 4 to 6 games at each site. But they can be moved around, so they can vary them, right? Much more effectively and cost efficiently. So they cost less and they're more effectively moved around. And they can also take to the franchise network as well. It'll be good for that. So basically, that means less cost, bigger margins. All right, so there's better terms as well. So they're returning to growth, and then bigger growth, more sites. Then those sites are more efficient. Okay, so that's reason 4. Reason 4 still, and this is what this is in like 2 parts. This section here, because of COVID. They've sort of benefited in a certain way, in a twisted way. They've been able to bolster their UK site. The number of fabulous new sites which have not been attainable 12 months ago. We've been able to secure terms which we believe substantially more favourable than would have been the case pre-COVID. We have a further pipeline of sites under discussion, a number of which are in locations which would previously have been too expensive or unavailable. So these are real high footfall sites which were unavailable before because they were busy. There's no units available or they're too expensive. Now the units become available. Or they can afford them. Landlords, our intention is to agree deals in which the landlords share a greater proportion of the trading risk, thereby reducing the operational gearing and downside risk to Escape Hunt. So less upfront, basically, that's what we're saying there. Less cost, less capital employed to get a new site online, which is very encouraging. A repeat of that. So return to bigger growth on better terms with new blue sky opportunities, reason 5. And this is a huge region. And this I invested in the company before this came around. This was created in May. So they released a digital strategy surpassing expectations, right? It surpassed management's expectations, significantly offsetting the reduction in site revenues, resulting from the temporary closure of a number of company sites. So everyone, investors who are not taking the plunge here, saying, well, the site's all shut, didn't see this. This digital strategy is offsetting the revenue from the physical sites. It was only created in May. This is nuts. So directors regard the development of... so basically, due to restrictions, they come up with this game in March. But directors regard the development of the digital and remote play products as strategically important for the long-term growth of the company, providing the ability to target new customers, segments, and build a strong B2B brand. Look, target new customer segments and build a strong B2B brand. So they are targeting now big corporate customers, clients, who want to add value to their employment, to their employees. So they arrange away day, team building, they invest in their employees. These are good companies. And so they can do this remotely. So look at this. In December, across 6 digital propositions aimed at B2B market specifically, the company delivered nearly 200 bookings, comprising of 1,000 corporate teams and over 6,000 individuals, as a testament to the scalability of these products. And that's key. It's scalable, low cost. The largest attendance in a single game, I don't know how they do this, single game, had 347 people split between 57 teams playing in the same game, all hosted by the company's in-house delivery team. And apparently there's 5 or 6 people just putting this game on. Normally that would take, 3 to 5 times as many staff if it was in physical rooms than that. So margins are lower. They don't have to have sites, pretty much, or lots of sites going on. This is a blue sky opportunity here. And people don't see this. They can be a global leader in this. There's no one out there doing this at this scale, delivering, 347 people in one game. The revenue from that is phenomenal, very low margins. That's the equivalent to 57 physical full escape rooms. So 57 rooms are on their group. That one game I'm talking about, that one game, not the rest of it, 6,000 individuals. Plus the margins are better and it's globally accessible, or scalable I should say. So on their website, unlimited players and teams, play from anywhere around the world. 5-star experiences, head-to-head competitive gameplay. I see this as a huge, blue sky opportunity for escape, and it wasn't there in May. People are not seeing this. So people are looking like back 6 to 12 months, and the sites have been locked. The stock market does not look backwards; it looks forward. Okay, think where they'll be in 6 to 12 months' time with the physical rooms, and now this. And apparently, they play at home games. The print and play games are doing very well as well. So you imagine that. Add those two together. And yet we still have a 12.2 million market cap. 12.2 million market cap is phenomenal. I mean, I've done videos, you've seen videos on this before. Roadmap to £1 at 15 pence at the moment. A fast-growing market leader with a premium brand in the leisure business. Look at any other leisure, okay? Bowling, cinema. They can't do virtual stuff, bowling can't. Not really that well, I mean, Hollywood Bowl can't do that. Or cinema can't. What else is there? Is paintballing. I've done that. Hated it. Can they switch straight away to a virtual model? No? What else? Just compare other leisure activities. This is growing very quickly. I think this blows them out of the water. I really think this is one to put on your watch list. Please do your own research. It's not investment advice, but so I'm very bullish on this. That's why it's my biggest position, and I'm not pushing it because it's my biggest position. It's my biggest position because I think it's got lots of potential. Look at the valuation. How many companies are valued more highly than that and have what they have? Not many. Thanks for watching. Oh, by the way, like I said, if you like this video, if it provided some value to you, please hit that subscribe button and notification bell. Sound a bit beggy, that. You don't have to, but if you want it to your inbox, you can. And also below the video information, you can see a link to my newsletter. I send that out as well. And I'm going to be using maybe that this year to flag up a project I want to start. It's about investing. So if you want to join my newsletter, it's free, of course. Once a week I send it out. Click that link there and just put your first name and email address in there. Thanks for watching, and until next week.